Hi friends, welcome to September-December 2019 SBR paper. So previously I have discussed in my previous video question 1. Now I'm going to take you through question 2, which is for 20 marks. So before I go through the background and the case study, let us read the requirements first. There are two requirements, A and B. And in your question 2, you will also get the professional marks. Your ethical questions will be tested in question 2. So starting with question A. Question A, requirement A, discuss appropriate accounting treatments which stent companies should adopt for all issues identified above and their impact upon gearing. The mark allocation is shown against each issue above. So the marks for this part is shown in the section above. When you read the case study, it is there, right? Appropriate accounting treatments. To answer this type of question, where you will be asked this type of question as well. Appropriate accounting treatments. They didn't specify a relevant IFRS or IAS. You have to decide reading the case study which IFRS or IAS is appropriate to deal with this situation. Okay, for all the issues identified above, that means there is more than one issue and the accounting treatments will be different for each issue. So that means this is not just one IFRS or IAS you are dealing with. There are several in this requirement and their impact upon gearing. So it's not just the accounting treatment for the issues identified above, also their impact upon gearing. So there are two things in this one requirement, single requirement. Coming to part B. The accountant has been in her position for only a few months and the finance director has recently commented that all these accounting treatments must be made exactly as I have suggested to ensure that the growth of the business and the security of all our jobs. Okay, so this, if you read this, it looks like they are threatening, right? Intimidating. Both finance director and accountant are ACCA qualified accountants. Now, why they give you this information? This information, something will be there. What is their post and all? The reason is because ACCA has the five fundamental ethical characteristics. What are they? Professional competence and due care, professional behavior, objectivity, integrity, and confidentiality. That's the reason why they have specifically told you ACCA qualified accountant. That means they have to follow these rules of ethics, the fundamental principles of ethics. So now you have to discuss the ethical issues arising from the scenario, including any actions which accountant should take to resolve the issues. It's not just ethical issues. Mind you, why most of the students go wrong is they always answer the ethical part and leave the action part. You also have to give actions, recommendations, how those issues can be resolved. So actions has to be there. Both together will give you 7 marks, right? Also, you are getting 2 professional marks here for the application of ethical principles. It's not that all the 5 ethical principles will be applied in this case. There will be only 1, 2 or 3 which is there. Sometimes it might be 4, sometimes it might be just 1, but mostly it is 2 and 3 ethical principles will be applied in the same scenario. So let us go and read the requirements first. So all this is for part A. If you see above, marks is given here, 4 marks. That means 4 marks for this issue, 4 marks for this issue, 8 marks, then 3 marks, 11 marks. 11 plus 9 makes 20. So 11 marks for part A. So all this is for your requirement A. Requirement B is this paragraph only. Only this 3 lines is for requirement B. That's it. So it will not be so tough for you to deal with requirement B. Let us answer the requirement A first. Stent company is a consumer electronic. Let's read the background first. It's a consumer electronic company which has faced a challenging year due to increased competition. Okay, so one, they have sometimes you are given some of the very key information in your background. If you get such information, highlight it, underline it, because you will be using it throughout the case study. Because we know what happens when competition increases. what happens? It can have an impact on your ethical issues also. You will likely to show yourself as you know getting high profit at a better better financial status. You want to show, maybe you will be getting bonus for that, so you will inflate your revenue, something like that, right? It's like window dressing. You are doing, manipulating the financial statements. When everything is going okay, there's no issue. That's why they have given this background information. Increase competition, challenging year, because at this time only chances are that issues will come up, ethical issues will come up, other issues also will come up. So one is increased competition. Stent company has a year end of 30th September 2009 and an unaudited draft financial statements report an operating loss. Unaudited, it is reporting an operating loss. When everything is going fine, profit and all, you don't have to worry. Usually they will not give also such things when everything is going okay. Otherwise, what's the issue of giving you issues and ethical issues and all? So it all only comes when things are not going fine, like when it's an operating loss, when you're going in a loss for many years, something like that. So in addition to this, debt covenant limit based on gearing are close to being breached. Please, debt covenant are close to being breached. Of course, when you're going in operating loss, you'll be taking more debts. That means your gearing will be high, right? Your gearing cannot be so high. There's a limit to that, right? That more than this percentage, if your gearing goes, you're breaching the covenant. Let's say the limit is 50%, but you are now at 49%. So it's just 1% more for you to breach that. And the company is approaching its overdraft limit. So now, how many issues are there? Now, 1, 2, 3 issues. There are 3 issues you need to deal. That means there are 3 IFRS or IAS you have to deal with. And how this will have an impact on the gearing. So 2 things you have to answer. So first we'll go one by one. I'm not going to read the whole case study. This is up to you. This is a choice. You can be flexible here. Either you can read the whole case study and then answer one by one, or either you answer one, you read one and then answer, then read another one, then answer, like that. I follow that strategy. Okay, so first, cash advance from Birdstar Company on 27th September 2009. If you see, the year end is 30th September 2009 and this 27th September 2000, very close, just 3 days before. Okay. Stent Company's finance director asked the accountant to record a cash advance of 3 million received from a customer. Okay. As a reduction in trade receivable. So when you're reading such lines, try to have a picture in your mind, imagination. Imagine that you are the finance director, you are telling the accountant. This is how you will understand a scenario better. If you're in it, just think this is your company. Don't think you're reading something else, someone else's. That will make you answer better. You can answer more points when you think it's your own company. You are the finance director or you are the customer. Okay, so they are telling the accountant to record a cash advance from customer. That means it will be a reduction in trade receivable, right? Because customer has paid in advance. So Buster is solely owned by State Company's finance director. Solely owned by State Company's finance director. If you see, there is some relationship. Can you see when I go to the second line? It is solely owned by whom? The finance director. This, he is the customer. Customer is solely owned. If you can see, there's a very close relationship between these two, the customer and the finance director. So this is leading you to some IFRS or IAS. I'm not going to answer it now. Let me read the whole thing. But this is too early to make judgment. Always read the whole and then decide. Sometimes in one there may be one or two together. It's not just one. So the accountant has seen an agreement signed by both companies stating that the 3 million will be repaid to the buster in 4 months' time. What did the accountant see? Agreement that it signed that this 3 million will be repaid to the customer in 4 months' time. The finance director argues that the proposed accounting treatment is acceptable So he's saying, the finance director is saying the proposed accounting treatment. What is this accounting treatment? Reduce it from trade receivables and record a cash advance of 3 million received is acceptable. Finance director is saying this is acceptable. Why? Because the payment has been made in advance in case the customer wishes to order goods in the next 4 months. However, the accountant has seen no evidence of any intent from the buster to place orders with this one. No evidence is there that they actually have an intention to place order. So what does this look like? Which IAS? For me, this looks like this is IAS 24 related party disclosure. Let us see that's what the answer is or not. I'm not going to any other. I'm not going to touch any other. So if you see the answer, how many marks is for 4 marks? If you see the answer is quite lengthy, it's a bit lengthy. You are not supposed to write this lengthy answer. So don't worry. When you see this answer, don't panic. Oh my god, how I'm going to write so much of lines, how will I memorize? Don't even think about memorization. It will not help you at all. Throw that out of the, you can only memorize the rules, that in this IFRS or this IAS, this is the rule, this is how you measure, this is how you disclose, this is how you recognize or de-recognize. That's it, you have to memorize. Rest all, the answers and all, you can never memorize. Don't even try, because each case study is different, each answers will be different. So here it is cash advance from this. Name it, put a subheading, name which issue you are talking about. Don't just write issues and under that issues don't write all the issues. There are 3 issues, so all 3 issues has to be there in 3 different subheadings. And even then, when you're writing, explaining, write in paragraphs. If you see, this is 1, this is 2, and this is 3 paragraphs are there, right? So what is the accounting treatment? For that, first you have to identify what is the relevant IFRS or IAS. Then only you can tell the accounting treatment. You just cannot write, okay, accounting treatment is not like this, it should be like this. You cannot write like this. Okay, and it has to be linked to the case study. So let's see how it has been answered. State company's finance director also controls. But so you see, control is the word. Finance director is controlling the customer. The control is the word here. Keyword. Always the key answers. Write it first. Don't leave it for the end. Don't leave the suspense for the end. That at the end I will write the main points, the key themes. If you are seeing anything, you have to write in the first. Why is that? Because you will miss out of time. Definite. You can never be, you will be always lagging behind that time, because this things does not come easily. First of all, you will take some time reading, then you will take some time planning the answer, then you will take some time thinking which IFRS or IAS. Then once you get it, when you write the points, just time yourself and see. You might be thinking of 10 points or 5 points, but you actually will be writing 2 or 3 points. You cannot write that much because of time limit. So that's why it is advisable the key points has to be written first. Later, if you have time, you can nicely decorate and write more points. No harm in that, no issue. But the most relevant point is control. That's why it's written first. So he controls. The company which has paid a cash advance to Stent. Okay, who is this one? They're telling Buster is the company who has paid cash advance to Stent. International Accounting Standard IAS 24. So the keyword here, let me put a highlight instead. IAS 24 related party disclosure is the one for this. If there are 2-3 IFRS or IAS in single requirement like this, or in a single issue, my advice is write it in different paragraphs. Don't write it in same paragraph. Even here also you can see later, I can see here there are 2 more, IAS 32 I can see, and IAS 1 in paragraph 2. They are written in separate paragraphs. So here we are going to talk about related party disclosure. Okay, what does this include? What does this related party disclosure says? That you have to write. So this requires an entity's financial statements to contain disclosures necessary to draw attention to the possibility that its financial statements may have been affected by the existence of related parties and by transactions and outstanding balances with such parties. From here to here, this answer is from your textbook. As it is, they have taken it and it. I'm not telling you to memorize, but understand it. You can write this on in your own words also. Okay. Included in the definition of a related party is a person. Now they are saying who are this related party. What is the definition of a related party? You have to give that definition of a related party. You just cannot say this is a related party. You have to give definition also. From the standard, give definition and then say whether in this case it is applicable or not. So included in the definition of a related party is a person identified as a holding significant influence over the entity. What is it? How do you say a related party? Holding significant influence over the entity, or who is a member of the key management personnel of the entity. So the finance director is a key management personnel. So you are also saying member of key management personnel. So even the finance director, this post is a key management personnel, right? Of Stein company. It's a related party. Now you can say it's a related party. Don't directly jump to related party. Okay, when you are given this type of scenario where you have to tell whether this is a related party or not, first you have to tell from the IAS 24 facts, the rules, that this are the related party. So in this case, he is the related party because finance director is a key management personnel. Significant, it has a significant influence over the entity, the finance director. Finance director is not some small post or something, right? So it's a related party. This is how you're building up answer. I'm not only showing you the exact answer. My point is to show you how to build up an answer, how to come to that point from the first line to this line. So now you have told that this is a related party. Now what? Now you have to tell what they have to do. So because in this case, 10 company must disclose. See the word they're using, must disclose. You're not giving any flexibility there. They can, they should. No, your word has to be very specific. This word has to be there. Must disclose. If you say they might disclose, or then your answer only changes, the meaning changes. It's like it's optional kind of. This is not optional. Once you are a related party, you must disclose or you should disclose. This word has to be there. So stand company, who has to disclose? The company has to disclose. My dear friends, name the company. Okay, so state company must disclose the nature of the related party relationship as well as information about all transaction and outstanding balances between state and Munster owned and controlled by the finance director. Now you see how they are saying that because they told that it is solely owned by the finance director, right? The customer. That's what they told in the case study. So this is one of the key information, key fact. They are directly telling you that it's a related party. You have to tell the nature also. You have to give the information about transactions and all the outstanding balances between the finance director, between the state company and the customer. Necessary for users to understand the potential effect of the relationship on the financial statements. So that's the first paragraph. Now coming to the second paragraph. What is it? What is another? Okay, now you can see the answer. That's why you will tell IAS 1 or IAS 32. But think, why IAS 1? Why IAS 32? How it came to there? Related party is direct, it's easy understand because it's directly. Sometimes like this type of issue you can see there are more than one which is hidden, which is not known directly by seeing at it, that also it can have an impact on this IAS or IFRS. Okay, so let's go to the second paragraph and read the first few lines to understand. Advance from this one, the Buster company means the conceptual framework definition of a liability. So because it meets the conceptual framework definition, it's a liability. You are receiving an advance, you have to pay it back. So the advance is a liability. That's why it is going to IAS 1. In the conceptual framework, it means the definition of a liability. You have to tell that. Don't say it's a liability. You have to tell it meets the conceptual framework definition of a liability. It has to be there. This word has to be there. Whether it's an equity, asset, liabilities, expenses, anything, if it meets a definition under conceptual framework, you have to write it. Okay. So stain company has a present obligation. Does it? Yes. Legally enforceable as a consequence of a binding contract. It's a binding contract. So this all this words has to be there. Liability comes means all this word will be coming there. Present obligation from the past event. All this thing automatically you have to write. So the settlement of which involves stent giving up resource and avoiding economic benefits in order to satisfy the claim. Yes. That means if stent has to settle it, that means its resources will be going out. So IAS 1, the next one is IAS 1. Presentation, I'm sorry. IAS 1 presentation of financial statements. This is the next one, right? States that an entity shall not offset assets and liabilities. Yes. You cannot offset assets and liabilities. That's what they told. All this are in IAS 1. When you read IAS 1, all these are there. The answers are there itself. There's no new piece of information is there. Unless required or permitted by IFRS. Finance director wants to include the receipt. So now you have to tell in this case what is the issue. The finance director wants to include the receipt as a credit balance in trade receivable. Credit balance, why? Because reduction in trade receivable means what? Credit balance only. See, trade receivables are debit balances, debtors, trade receivables. So when you have to reduce a trade receivable, you have to credit the balance. You cannot debit it. If you are debiting, you are increasing it. Be very careful. Reduction means debit, credit. You are crediting the trade receivable to reduce the trade receivable. Okay. So they want to include the receipt as a credit balance in trade receivable. You're reducing the trade receivable. That's what they mean. In another word, they are saying this. That means what? That receipt you cannot reduce from trade receivable because they told asset and liability. What is an asset? Trade receivable is an asset. That advance is a liability. You cannot offset. That means you cannot reduce also. Understood? So netting of any amount owed by buster from trading with what appears to be a short-term loan. You cannot do that. IAS 1 does not permit it. So this would result in a misclassification of a current liability under current assets. Exactly. What will happen? Misclassification of current liability. Yes, because trade receivable is current asset. If you're crediting it, the balance will reduce. So that balance will be treated as what? Trade receivable only. Current asset only. Because ultimately that reduced trade receivable, where will it come? Under current assets only. There will be no liability at all. But in fact, there's a current liability. So that will not be shown. So it's a misclassification. Right? So offsetting a financial asset and a financial liability is permitted according to IAS 32. Now why are you talking about IAS 32? Because that offsetting is allowed. You said offsetting is not allowed, but financial asset and liability can be offset. Under which standard? IAS 32. IAS 32 financial instruments. Presentation. You have to write this word presentation. Because if you are just saying financial instruments, you'll be wrong. Because if you are just saying financial instruments, it will be IFRS 9. But if you're talking about specially for the financial instruments, the presentation, you have to write it IAS 32. So these are some silly mistakes which you cannot afford to make it. That's why I've underlined presentation also. So when and only when an entity has a legally enforceable right to set off the recognized amount and intend to either settle on a net basis or to realize the asset and settle the liability simultaneously. So they have given all the background information under which condition you can set off assets and liability. This is from the standard. You read the standard, you will get it. Nothing for me to explain here. But in this case, you have to say that no such agreement is evident in this case. If it is evident, you can write yes. In this case, it is evident. Therefore, you can set off. If not, you have to write it no. There is no such evidence in this case. That also you have to write. Both ways you have to write. If it's not, you just cannot leave it. Okay, it's not written, so I will not write it. You have to write it if there's no evidence. That you have to write. So stent Since there's no evidence, stent company should report separately both assets and liabilities. They should separately report both assets and liabilities. This you have to write. Because there's no agreement for that they can be offset like that or not. So separately assets and liabilities. Last paragraph, let's see. Last, you have to talk about how this will have an impact on the gearing. Except when it reflects the substance of the transaction or other event. Offsetting detracts from the ability of users both to understand the transaction, other events and conditions which have occurred and to assess the entity's future cash flows. Stent would be showing a lower current asset figure and concealing their liability. What happens if they do that? If they offset, they are saying. So what happens when they offset? They are giving a background. What happens? If you offset, your users will not be able to understand how to assess the entity's future cash flow because there will be no liability. There will only be a reduced current asset. That's it. From that, they cannot understand. There's one problem. Another one. Stent would be showing a lower current asset figure, yes, and concealing their liability. This is an issue. Remember trade receivable? Credited, lower current asset and concealing their liability, no liability. That means if you see a financial statement like that, you'll be thinking, wow, this company is in a good liquidity position because no liability. But in fact, there is a liability which is hidden in current asset, which if disclosed as a current liability. Now, if you disclose it as a current liability, would be included in the debt element of the gearing calculation. Don't forget to write this. Because obviously when current liability is shown, where will it be there? It will be included in the debt element of the gearing. It's a debt. So in the gearing calculation, it will have an impact because your debt will increase. So gearing would therefore increase. Definitely. Debt increase means gearing will increase. Right? Now let's come to the next issue, which is about convertible redeemable preference share. But we didn't read this, so we have to go back and read it. If you see here, this is the I think the lengthiest. Let's see. It is for 4 marks, same marks. So don't get scared by reading such long answers. Your thing is just write the main points. It's for 4 marks, so just write 4 points. That's it. The why it is lengthy is for you because they're explaining you for your explanation purpose. In the real exam, you're not supposed to. You cannot also write that much answer, so don't try also that I'll be writing all these answers and getting full marks. Now let's go to preference share. On 1st of October 2008, the CEO and the finance director each paid $2 million cash in exchange for preference share from Stent Company, which provides cumulative dividend of 7% per annum. This preference shares can either be converted into a fixed number of ordinary shares in 2 years' time or redeemed at par on the same date at the choice of the holder. Okay, either it can be converted to fixed ordinary share or redeemed as same date. The finance director suggests to the accountant that the preference share should be classified as equity. Because the conversion is into a fixed number of ordinary shares on a fixed date, fixed for fixed. It's for fixed number of ordinary shares on a fixed date. That's why they told it has to be classified as equity, and conversion is certain given the current market value of the ordinary shares. So you have to tell whether this is appropriate or there should be some other accounting treatment for this issue. This looks a little not a very familiar type of question, right? Okay, so we'll go to the answer. Which IFRS IAS is coming in your mind when you're talking about preference share conversion? Main thing is IAS 32. Yes, IAS 32. Directly just jump which IFRS and IAS you're talking about. right? So now this item. So now we are going to read the first paragraph. This whole thing is in first paragraph only. The reason why there's a space in between is because it's on a separate page. That's why. IS 32 defines an equity instrument as any contract. So now you're saying what is IS 32? It defines an equity instrument as what? Whenever these terms come, equity instruments, or it has to be converted to equity, something like this, it is IS 32. Because IS 32 defines an equity instrument. IS 32 talks about equity. There is no other standard which talks about equity. You have to be very strong with your all the IAS and IFRS to deal with this type of questions. This requirement A to get that issue and solve an accounting treatment. So IAS 32 defines an equity instrument as any. So this I can read fast because it is from your IAS 32. You can read there in your textbook. Defines an equity instrument as any contract which evidences a residual interest in asset of an entity after deducting all of its liabilities. Whatever is remaining after deducting all liabilities is your equity. An equity instrument has no contractual obligation to deliver cash or another financial asset. These are very important words. See, this has to be there in your answer. Okay, it has no contractual obligation to deliver cash, equity instrument, because that is your debt instrument only has this, or another financial asset. Or to exchange financial assets or financial liabilities under potentially unfavorable conditions. If settled by the issuer's own equity instruments, an equity instrument has no contractual obligation to deliver a variable number or is settled only by exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. All these are from your standard. So quickly I'll go to the second paragraph. Preference shares which are required to be converted. Now we are talking about the conversion. Okay, required to be converted into a fixed number of ordinary shares on a fixed date should be classified as equity. They are saying it should be classified as what? Equity. Only for which part? That part. Conversion part. Fixed number of ordinary shares on a fixed date. This is known as fixed for fixed requirement to which the finance director refers. Correct? However, these are your connecting words. When you have to go to the next line, when you have to say something which is contrasting to the first line what you said, or something drawback or something you want to say. However, but. So however, critical feature in differentiating, you have to differentiate a financial liability and equity instrument, my dear friend. Okay, so the key word let me highlight it as financial liability and equity instrument. You have to differentiate it. How do you differentiate? Well, the key feature, the critical feature is existence of the contractual obligation of the issuer either to deliver cash or other financial asset to the holder or to exchange the financial assets or financial liability with the holder under conditions which are potentially unfavorable to the issuer. If you have a contractual obligation, so all these terms, if you have, then it's a financial liability. If you don't have a contractual obligation, it's an equity instrument. Remember. So all these things has to be there. In this case, Stand has issued what? What did the company issue? Convertible, redeemable preference share, which makes little commercial sense from the company's perspective as they offer the holder the benefit of conversion into ordinary shares if share price rises. Yes, if you convert to ordinary shares, who is going to benefit? The company. If the share price rises, and the security of the redemption at the choice of the holder if share price falls. If the share price falls, redeem it. Don't convert to ordinary share. Redeem it. Because the holder has a choice. Now let's go to IS 32. All these are your standards only. It's like copy paste, nothing new. So IS 32 knows that the substance of a financial instrument rather than its legal form governs its classification in the entity's statement of financial position. A preference share which provides for mandatory redemption for a fixed or determinable amount at a fixed or determinable future date, or gives the holder The right to require the issuer to redeem the instrument at a particular date for a fixed or a determinable amount is a financial liability. What is it? It's a financial liability. So read this again to understand. Did you understand why it is financial liability? After reading financial liabilities feature. Next. Because the preference shares offer the holder the choice of conversion. Yes, it offers the holder the choice of conversion into ordinary as well as redemption in 2 years' time. They have two things. Either they can convert into ordinary shares or they can redeem in 2 years' time. It's a choice for the holder. The terms of financial instrument should be evaluated to determine whether it contains both a liability and equity component. Yes. At times, it contains both the component, a equity component also and a liability component also. Such components, if it has both, it is classified separately as a compound financial instrument. Recognizing separately the components of a financial instrument which creates both the financial liability of the equity entity, a contractual arrangement to deliver cash and other financial asset or an equity instrument, okay, and an equity instrument. A call option granting the holder the right for a specified period of time to convert it into a fixed number of ordinary shares of the entity. Coming to the next is they are talking about IFRS 9. So this is another standard. It is financial instruments. In accordance with IFRS 9, when the initial carrying amount of a compound financial instrument is allocated to its equity and liability component, equity component is assigned the residual amount after deducting from the fair value of an instrument as a whole, the amount separately determined for the liability component. That means you must be very well known by now. You should know this, that when you have calculate the compound financial instrument, you first calculate the liability part. Okay, so from the whole financial instrument you deduct that liability component, and whatever is remaining residual is equity component. That's what it means. It is for the residual component part, equity component part, I'm sorry. So Stein would measure the fair value of the consideration in respect of the liability component based on the fair value of a similar liability without any associated equity conversion option. Everything is all this in IFRS 9. Read it, you will understand that the equity component is assigned the residual amount. Now the last paragraph, gearing. If you see, all the issues are like that. The last paragraph will be for your gearing part. Just 2 lines. It could be even 1 line also. Don't stress yourself why it's so less. It can be 1 line. Max is 5, minimum is 1. Gearing would decrease. Here they are saying gearing would decrease. In the first issue it would increase. How gearing would decrease? If the draft financial statements has included the preference share within equity. If it's within equity, the correction would increase non-current debt. So if you correct means what? Correction means what? Correction means you are increasing, you are deducting, taking it from equity and taking in the liability component. So the correction would increase non-current debt, present value of future obligations, and decrease equity. If it is within equity, gearing would increase. But if it is not in equity, if it is in liability component, gearing would increase. Now coming to the third, deferred tax asset. Please go through this preference shares once again, because first issue, cash advance, and the third issue, deferred tax asset, is somewhat easy to understand. But preference share, this type of area is little complex to understand, especially when it deals in IFRS 9 and IAS 32 and all this standard. It's little complicated. It's the most toughest standard in SBR. So go through over and over again. Just reading once is not enough. Trust me. If you understood it in first time, that means you must be very smart, very, I would say, I don't know what. But usually first time reading is not enough. Unless you are very, very thorough with the standard. Then you will not make mistake also. Now coming to the deferred tax asset. Definitely looking at the word deferred tax asset, you know it is IAS 12 only. And it's for 3 marks. So this should be more simpler. Stand includes the deferred tax asset in a statement of financial position based on losses incurred in the current and the previous 2 years. Based on what? Losses incurred in current and previous 2 years. The final status asks the accountant to include the deferred tax asset in full He has suggested this on the basis the Sten will return to profitability once his funding issues are resolved. Sten company didn't return to its profitability yet. They are just saying that it will return once funding issue is resolved. That's why they are saying that it has to be recorded in full deferred tax asset. Now you have to talk about IAS 12 here. If you see, it's very small, smallest, right? Now you see the marks. The lesser the marks, the lesser will be your paragraphs and your so deferred tax asset. Is it? It is IAS 12. In accordance with IAS 12, do you see each question, each issue? They are saying in accordance with IAS 12, in accordance with this standard, in accordance with that standard. So this is your starting. So in accordance with IAS 12, a deferred tax asset shall be recognized for the carry forward of unused tax losses to the extent that it is probable that the future taxable profit will be available against which the unused tax losses can be utilized. This is a rule. Second paragraph. Now you are explaining the issue. So first paragraph, rule. Second issue, you are explaining. Third, you're gearing how it will affect. However, the existence of unused tax losses is strong evidence that future taxable profit may not be available. Sometimes you have to tell from based on the case study whether it will be available or not, because it has huge tax losses, operating losses. Even from the background, I will tell you, we have just highlighted in the background. If you see here, reporting an operating loss, increased competition, facing a challenging year, all this are saying that it's hard in the future to get a profit, taxable profit, because they are near to breaching their debt covenant also. So what happens? What happens because of that? Existence of unused tax losses is strong evidence that future taxable profit may not be available. They didn't say it will never be available. They said may not be available. There's a probability, high chance of not being available. Seeing the current situation, you have to be able to predict like this. Seeing the current situation, what will be an impact on the future sometimes. So therefore, based on this, you are saying therefore, when an entity has a history of recent losses, the entity recognizes a deferred asset arising from unused tax losses only to the extent, not in full, that it has a convincing evidence that sufficient taxable profit will be available against which the unused tax losses can be utilized. Only up to that amount, only deferred tax asset can be recognized. If you can utilize your tax losses, unused tax losses against your future taxable profit. In such circumstances, the amount of the deferred tax asset and the nature of the evidence supporting its recognition must be disclosed. Amount of the tax assets, nature of the evidence supporting is okay, its recognition must be disclosed. Must be disclosed. How it is supporting? What is the evidence? That evidence also has to be disclosed with the amount. So the director of Sten should disclose whether it is probable that Sten will have taxable profit before the unused tax losses or unused tax credit expire, whether the unused tax losses result from identifiable causes which are unlikely to recur, and whether tax planning options are available to the entity which will create taxable profit in the period in which the unused tax losses or unused tax credits can be utilized. To the extent that it is not probable that taxable profit will be available, that taxable profit will be available against which the unused tax losses, unused tax credits can be utilized, the deferred tax asset should not be recognized. If it is not probable that there will be future taxable profit, you cannot defer the deferred tax asset. Till that amount, you cannot. Okay. Now, this is easy. This is quite easy. You'll be easier. It's easier to understand. Nothing much to explain. So last line, one line is only for gearing. Removal of a deferred tax asset would reduce net assets and equity. Gearing would therefore increase because your deferred tax asset reduce net assets and equity. Therefore, gearing also will increase. Okay. Now let's go to part B. Ethical aspect. So now you must be very familiar with how to answer this type of question. This is only for this year. Try for other years also. 2020, March 2020, September 2020. Try this type of questions. Because this type of question has a common pattern of answering. Only the IFRS is different or IAS will be different. That's it. So part B is 7, 9 to 9 marks. Ethical issues. Right? We have read the case study also. Keep it in front of you and then go through the answer. So ethical aspect. Ethical aspect. I want to warn you in ethical aspect is the see ethical aspect is easy to understand, easy when you're reading also, easy when you're studying also. Difficulty comes when you have to answer a question like this. Only 3 lines, what to answer, how to start, in between what I have to write, how to end. These are some of the key questions every student has from ethical aspect, right? And ethical aspect, usually it is done good, it is done fairly well enough by most of the candidates. The reason is because students try to copy paste, they try to memorize an ethical answer, which is not totally, I will not say don't do it, it's not wrong, because ethical answer is what somewhat similar in nature. Professional competence is there's a threat to professional competence or threat to objectivity, threat to integrity, threat to confidentiality. So all these things are very similar, very common. So ethical aspect is the area where you can score the maximum marks. So don't let this marks go by. Don't ignore this part. Ethical issue, don't just read. Write the answer. Writing and reading is two different things. When you don't write, you will not understand. You just think, okay, there are 5 professional ethical principles are there, I will just go and write 2 or 3. Does not work like that. So let's go to ethical aspect. Let's see how many, just see the number of paragraphs it has. Right? So now, since they told the finance director and accountant both are ACCA, so we are going to follow the ACCA guideline. So the ACCA rule book contains the bylaws and regulations and the code of ethics and conduct which every ACCA member should follow. For ACCA member, we have code of ethics which we have to follow. That in the first line you have to write, because specifically it is told that they are ACCA member. It is there for you to write this. Now, let's go. Accountant. We are going to the accountant. Now think you are the accountant who has been pressurized. What you have to do in that as an ACCA member. Think. Okay. As I am reading the answer, you think you are the accountant. Okay. So the accountant may feel, how will you feel when you are pressurized by someone? Accountant will feel, they will feel pressurized, right? You will definitely feel pressurized. So accountant may feel pressured by the finance director's comment on job security, given the accountant has only been in her position for a few months. This is the basic fact from the case study you have to take. Because in a few months, you cannot even say anything. You are new to the job. You have to listen whatever is told by the finance director, even if it's wrong. You know it's wrong. Ethically, it's wrong. You are being pressured. You feel pressured, right? So write it. The accountant should comply with the fundamental. Now you see, accountant should comply. Now, with whom? Not with the finance director. ACCA rule book says with the fundamental ethical principles set out in the ACCA rule book. What are they? Write all the 5 to add with integrity, objectivity, professional competence and due care, confidentiality and professional behavior. This 5 you have to memorize, you have to know it. You have to follow all this. So accountant should be mindful of any threat to this fundamental ethical principles. Yes, if you see that there's a threat to any of these 5 ethical principles, accountant should be mindful to that. In doing so, accountants should consider the relevant facts, the ethical issues involved, fundamental principles which are threatened, whether internal procedures exist which mitigate the threats. Also, you have to see the internal procedure. Are there any whistleblowing procedure? Can you report to someone inside the company if such things happen, so that the issues, the threat mitigates? And what alternative courses of action could be taken? Also, alternative courses of action which could be taken. You have to take all this into consideration, right? Second paragraph. In this case, now you are referring to the case, coming to the case. First, you say these are the ACJ guidelines, you have to follow all those things. Second paragraph says, in this case, all fundamental ethical principles, with the exception of confidentiality, appear under threat. That means, except the confidentiality part, other all the four ethical principles are under threat. What are they? Integrity, objectivity, professional competence and due care, professional behavior. See how they're saving time, how they're writing the answers in short. If you wanted, you could have written like this. That integrity, objectivity, professional competence and due care, professional behavior, all these are under threat except confidentiality. Now, it's correct. You are right. Same thing only. But if you're writing all these things, aren't you wasting time that you are writing more now? Sentences are long. You're wasting more time to write, right? So always try to keep as short your sentences as short as it is if it explains everything. Like this, with exception of confidentiality, all are under threat. Short, meaning is clear, saves time also. Okay. So the finance director appears to be allowing bias and undue influence from the pressure imposed by debt covenant gearing and overdraft limits into the choice of accounting treatment. Yes. Why they are going by that accounting treatment? So that they can debt covenant. So they reduce. They are breaching, but they don't want to show that they are breaching. If they show the correct accounting treatment, they will be breaching the debt covenant gearing. You've seen all the three conditions, gearings are increasing. That's why in order to do that, they are showing the opposite of it, so that gearing reduces, which is not correct, right? Ethically, it's wrong. And overdraft limit into the choice of accounting treatment. They are going by their choice of accounting treatment rather than following the accounting standards. They are not following the accounting standards. We saw in requirement A, they are following their own choice only because they don't want to breach the debt covenant. They don't want to exceed the overdraft limit, right? It's a bias. So the company is in a precarious position, reporting losses in the year. You have to talk about the company. I have told you, reporting losses in the year, operating losses. From the background, this information is taken. Ethical issues usually you can take from anywhere in the case study. You can use a whole case study. It's not just limited to that 3 lines only. That's why I advise that when you are writing ethical issues, write it at the end. Always write the ethical part at the end after you write all the requirements first. It's easier for you because now you know what are the issues, what you have dealt with, how it can affect gearing. Now it's easy for you to write the ethical issues. If you're going to write the ethical issues first and then section 8 will be a little tough for you. So my advice is write ethical questions, ethical requirements at the end. The last requirement should be. Because you might use a whole case study. You are free to use. It's better to use a whole case study for ethical issues. Sometimes you have to take from background, sometimes you have to take from in between, sometimes like this at the end, okay? So now the finance director should act professionally in accordance with applicable technical and professional standards, comply with relevant laws and regulations, and avoid any action which discredits the profession. Yes. The finance director faces an advocacy thread. Which thread? Please name the thread also. You know there are 5 types of thread. Familiarity thread, self-interest, self-review, advocacy, right? Intimidation thread. So here it is advocacy thread. The word is advocacy. By promoting accounting treatments which compromise objectivity. Exactly. It is not objective, it's bias, right? Something which is bias is not objective. The accountant faces an intimidation threat also. So this is another threat. It's not just one threat. Accountant is facing an intimidation threat. See, the finance director faces an advocacy threat because they have to advocate in the favor of the company. Okay, accountant is facing some other threat. Accountant is facing intimidation threat by the finance director. Okay, given the comments from the finance director, because finance director is forcing them to do something. Accountant, who presumably has an influence over the career prospect. Who has the career influence over the accountant? That is the finance director. Finance director can see the accountant. He can throw the accountant out. So because he's in that position, accountant is in a weaker position. He's facing an intimidation threat. Assuming the accountant wishes to keep her job. Now assume. In ethical issues, you can even use assumption also. Assuming accountants don't go by ethical issues, what happens then? What happens if they go by ethical issues? So you can answer this way also. That's for 9 marks. So feel free to answer both the ways. Because ethical issues is hard to come up with points. It's for 9 marks. But it's not easy for you to come up with 9 points. You have the professional marks also here. So assuming the accountant wishes to keep her job. This intimidation thread is also linked to one of the self-interest. Correct, no? Because he wants to be in the job. He has a self-interest there, the accountant. So it's also self-interest also. So before acting, the accountant should speak with the finance director, try to confirm the fact, discuss the treatment with the finance director, and explain the risk of non-compliance. Before acting, first what they have to do, explain, this are your professional marks. This is how you're getting your professional marks are here. Professional marks does not mean you're writing 2 more points and getting 2 marks extra. Professional marks means how you're answering it. What is the tone of your answer? When you have to convince someone, right? This is like you have to convince your finance director first before taking any action. Definitely, if you see a fraud, or let's say an example, when you come late to a class, immediately the teacher will not tell you, okay, get out or don't come. They will not take strict actions immediately. The first time you do, you will be signed a warning. Second time you do, another warning. Third time you do, they will dismiss you or do some strict actions they will follow. So it goes on stages. So in this condition also, you cannot say, if you're writing an answer like this, you cannot say, okay, leave the job, resign the job, accountant should not do a job in this company. You cannot go by this strict reasons. If you do that, okay, technically, okay, you might be right, but professional marks you will lose. You will not get those 2 professional marks because that's not how it works in reality. When you advise someone, you don't go strictly by sacking someone off or, first you try to explain that person, try to confirm the fact, discuss the treatment, and also tell them what happens when they don't comply with it, the risk of non-compliance. Then later, the safeguard of accounting regulations. Okay, what are the safeguards? Okay, because if you go by accounting regulations, you're safe. You're saving the company. The reputation is saved. You don't have any things to worry about. There'll be no sanctions against you. And the sanctions imposed on these professional accountants who do not comply may resolve the issue. Yes, because you are a professional accountant, an ACCA member, if you don't follow these rules, it will be not only for your job, it will be harmful to your reputation also as a whole. Okay, to that profession. So a record of conversations and actions should be kept. This is your professional marks. You see, these are actions you are telling what you have to do. What happens when you converse with someone like this? You keep a record, has to be there. What actions you are taking has to be kept. Stent may also have internal procedures which mitigate their threats. Yes, they might have. Not clear from the case study. It may be that the finance rate is not technically up to date, in which case a safeguard should be to undergo continuing professional development. See, all these are actions you are telling. When you are giving actions, feel free to give as much actions as you want. Don't limit yourself, okay, I will only give 2 actions or 1 action. But when the time is up, you have to go to the next question. Then leave it there. Then stop with your action, give a conclusion, that's it. Or recommendation. Final recommendation, that's it. So if the finance director refuses to comply, now you have, what is the next step? Next step is, one thing you are convincing the finance director. Next, what if they don't agree or they don't get convinced? If the finance director refuses to comply with accounting standards, then it would be appropriate to discuss the matter with other directors or audit committee if applicable. This is your next stage. When you answer any ethical issue in future also, go follow this step. First, you always discuss with the person. Number one, discuss with the person who is involved there. Your finance director, whoever is intimidating you. It could be a finance director, it could be any director. Second step, if they don't agree, then you have to talk with the audit committee or other director, whoever is there in that post. Last, only you will tell to resign. So this has to be the steps. Any ethical questions? So remember these 3 steps. Okay. Audit committee, if applicable, to seek a solution, then seek professional advice from ACCA. Yes, you can even seek professional advice from ACCA because you are an ACCA member, and consider any legal advice if necessary. Yes. Consider legal advice if necessary. Keep your tone like this. You can even copy paste also if this similar question comes like this. A final consideration for the accountant, if matters cannot be satisfactorily resolved, would be resignation. Now you see, would be resignation. They are not saying you have to resign, don't do work over here. No. So that's it with this. We finished question 2, and next is question 3 and 4 I have to discuss for the same paper. Till then, don't forget to subscribe to my channel. Keep subscribing to my channel and bring more subscribers. Right? Our aim is to make this million subscriber channel so that all the accountants, all the ACCA members, affiliates from all over the world gets the benefit, stays up to date with this kind of videos, and also help others to reach my channel and help them to pass this exam. Right? We are not alone. We are together in this. Thank you and stay well. Take care.